Brigitte is the head of Go Beyond Angels in Switzerland. It seems you want to spend some time in a nice sunny beach, so they've also set up in Naples, Florida, and in Malta. Brigitte, I understand you're European Business Angel of the Year award in 2015, and an investor for a couple of decades. So thanks for joining us. I'll hand over to you to take us through your presentation, do a bit more of an intro, and then we can do some Q&A.
I heard Minister Joy talk about that we have similar opportunities and challenges as Swiss. And then I love Deborah when she says looking under the hood, because that's exactly what I'm going to do. Show you a little bit on our angel investing platform. Indeed, we've been tracking since day one. What's great is many of our investors invest via syndicate. Actually is often a legal structure or a trustee or like nominee structure. So we have all the data. So we don't have to beg. We actually have data. So I'm going to be able to share with you the data that we did that was from 2008 to 2015. And for us, it's super useful because we're very focused on having fun as being angels and at the same time taking it pretty seriously on building our portfolio, managing it, and then exiting. And it's so funny, you were just talking about being board members. We do a lot of education, and our latest one is a board academy. And actually in Switzerland, we had the first session 2 days ago, and most angels left the room going, oh shit, I thought it was much easier being a board member on a start, but the actual levels of responsibilities and liabilities are in certain countries are quite high. So we learn a lot, but there's also a lot to be done when we're board members of startups. So what I'd like to share with you is a little bit on how are we doing as a community of angels? Then a little bit twice a year, we step back and we have these great meetings because we can all see each other's portfolios. We don't have the names, but we see a bunch of them are doing really well. Some are doing okay, some are not doing so well. And we really try to extract learnings from that, knowing that angel investing is both an art and a science. So some things it's kind of luck, but there's certain things that definitely over time we keep seeing over and over again are key success factors. And then the experience that we've had on exits and what's starting to become kind of some best practices or tips that we have on that. So indeed, I'm entrepreneur, investor, and for not quite past decades, but 13 years, so it's a pretty long time. And I'm founder of Go Beyond, and really, and Dana is with you. Dana was one of our first members in our Paris group, so also she can give you lots of information about what it's like to be an investor in our community and our platform. And so I basically became or created Go Beyond Investing after a few years of being super frustrated of tired of hearing all the jokes of haha, you're an angel, so how much money have you lost, and saying, well, the best way to learn is just write checks and hope. And when I asked, can we do things internationally, it was like, no, you're in Zurich, so join the Swiss German group. My Swiss German's not very good. And also not seeing much diversity in the types of angels. And so basically when Go Beyond was created in 2008, where this is all the data at the end of 2015. We were over around 300 plus members. We're now 450 plus members, primarily across Europe. But we're super proud because we're in 30 different nationalities, living in 20 different countries, and we really created from the beginning an environment where diversity was going to be cherished, first in terms of geographical, because the entrepreneurs really like to join our community because they know that they'll be able to access investors as they grow in various countries. Secondly, the gender diversity. We're close to now 50% women compared to in Europe, it's about, I think, 7% the average, so we're very proud of that. And also age diversity is really important for us, and especially because when we look at some brand new trends, brand new sectors, we find the new generation gets it much more than those of us who are maybe more in our 60s, who might have more money, but maybe less knowledge of certain categories. So diversity, we think, is a key element in building a strong investor community. When we look at a little bit, and Deborah talked a bit of why, if we look a little bit of who are the people in our community, we have only actually about 20% of people who are retired, or the new term, I don't know, in Europe, what we call portfolio careers. So it's a bunch of us like me. I stopped kind of in mid-40s, but actually continue to work, but might be wearing several hats. We have 20% that are in transition, and 40% that are actual still very active professionals. Usually they decide that they want to allocate 2 to 5% of their wealth, which is what we recommend for this high-risk asset class. But they want to, rather than just giving it to their bankers, have a bit more direct view on what they're investing in. And then back to this new generation, we have about 20%. This is our faster growing segment of future entrepreneurs, but often who've gotten engineering degree, MBA, but have decided it's not quite yet time to go and be an entrepreneur. And being an angel, especially in our community, you can start and have a full portfolio with as little as $10,000. So for them, it's like fantastic to be able to do that. So as I mentioned, we look a lot like an angel network at first. Last night we had Zurich, which ended quite late, which is also why, unfortunately, I couldn't be in person with you. And so we meet. The deals have been screened we have about 10 different subcommittees by theme, been screened. The entrepreneurs come and pitch. We decide if we're going to enter due diligence and who the couple people in the community who are going to take the lead. But then, as I mentioned, the whole thing, once we make investments, is really about how do we build, manage, and exit, and learn from each other on that. We're really quite excited because we've really gotten people, when they join our community, it's really to build a portfolio. And so up to now, we've done 133 rounds of financing in over close to 50 companies. There's a 79% activity rate of our members in terms of investing. And for those who've been in our community for 2 years or more, there's 77% who've gotten liquidity. Now, that's really unusual for angel investing. And I'll show you, because Deborah also mentioned follow-on rounds. For us, that's a critical thing. We have ways now that our members can get into deals that are closer to exit, so closer to liquidity, still with small tickets, which is a key success factor for our members. Where do we invest? In terms of sectors, we actually look pretty equally between the whole mobile telecom, which is kind of ICT, industrial deals, technology, consumer, so new brands, and healthcare. But when you look at which deals are chosen, it tends to really be that the deals are primarily industrial and some consumer and some mobile and mobile internet. Geographically, again, we have 9 physical chapters, and then the rest is all done virtually. But actually, we have a lot of the deals end up being in Switzerland. And Switzerland is probably a bit like New Zealand. It's actually a fantastic place. You said you guys were number 1 as easy to start businesses. Switzerland's also pretty good. It's also quite simple for investors. We just don't pay capital gains. But there's also really a nice exit market. So that's where actually we end up spending more. The rest rest is in the rest of EU and other parts of the world. Now, the cool thing is that since 2015, we've been analyzing for years, but we've been publishing kind of the first in the industry report on actually looking at individual angels' portfolios, so everyone in our community. And the first thing is it's the second year now that out of the close to 60 companies have invested, and so here we're talking about close to 17 million francs invested. Actually, when we look at those who have exited, either died or we've gotten cash, we continuously are that pretty much as much cash has gone out as has gone in, and yet we're still sitting on 50 deals that are alive and doing pretty well. So they should also get good returns. So that's where we felt it's not, what I'm going to tell you is not just about theory or net asset values. It's also because now we're starting to have real liquid. Every few months or every 6 months there's company that exits. Now for us, back to how are angels doing? We're very passionate at success, especially while making it accessible to a number of individuals. And so here this shows, for example, the angels in our community who've built a portfolio of 5 or more deals. And on the left, you see people who invested less than $50,000 to build that portfolio. And on the right-hand side, those who invested more than $50,000. And what's interesting, it's very close. So for us, that's great. That means you can still be a small angel and have as much chance of doing well. The other thing is that the dark gray is those who are more on a negative annualized return. Those are bluish is more neutral or positive annualized return. And so we're seeing, as opposed to what we often hear is that 80% of angels lose most, if not all, of their money. Here, our community is more like 80% are more in the neutral or positive. And we have to remember that more than 50% of members who join our community have never been an angel before, and we're not a fund. People work a lot together, but most of the time they make their own decisions. So for us, that was great for the industry to be able to say, we can democratize and professionalize and treat this as an asset class. So now, okay, so what's the secret sauce? Again, there's still a lot of art. All of you in the room are angels, as you know. There's still nothing like being able to look at the entrepreneurs in the eye, being able to look at co-investors in the eyes, but we're finding there's some things that continuously the members in our community who are doing well do more than the others. So in general, the first thing is really about taking a managed approach rather than kind of saying, hey, it's lottery, let me just bet. The other thing is really, I think you touched a little bit about that on follow-on rounds. I think it's great. I think you mentioned 70% is follow-on rounds. The data shows that's probably really smart. And also, of course, having good deal flow, that's kind of a given. But we have to remember garbage in is garbage out, so quality in probably helps later on. And as much as possible, that I think I heard you have a number of networks, and that really helps that there's investor communities who look at it. We also use a lot, even if people have a lot of money in our community, they often use the ability to do small tickets, especially the first 2 or 3 years, because that's where they can also really learn. And it's really important to be able to share all the experience. We have 16 modules of education, and these can be videos, they can be webinars, they can be in person, and we continuously update it. Just last night at the Zurich meeting, there's 3 deals we looked at and said, oh my gosh, those things, what we just learned, let's make sure they go into the education, because it was a very interesting case study. So at the end, we all have a lot of fun, but at the same time, really take it seriously. So here's a little bit of data following this up, the portfolio. So every little dot is a member in our community. And basically, it really statistically shows that those who have less than 10 pretty much investments, their potential or their annualized portfolio return is very erratic, where those, when it starts becoming 5, 10 or more, it's much more sustainable. Unless we do have a few members in our community who are doing very well, they only pick one sector, they might only do 1 or 2 investments maximum a year, and they're very involved. So that is actually, and often it's tied to what their family business is. So that is actually quite strategic investing, which is different than portfolio, and that can be. But for those of us who are doing it more as a percentage of our wealth to manage, diversity looks like that's the key, and portfolio building is critical. The second thing is here to show in terms of the gray ones are people who are the larger investors in our community. Blue is smaller investors, and it shows that even there, when people have the choice, they're picking kind of $6,000 to $9,000 as a typical ticket. Now, of course, the entrepreneur doesn't want a bunch of $6,000 to $9,000 investors, so that's why we've worked really hard over the years to make sure that there's a way that's tax transparent, where people can still make their own investment decision, but that they are on the cap table, they appear at 1, and that they're represented by a lead investor from the community. The big thing this year, so there's something red on top, was to say this whole thing of, we're investing quite a lot in follow-on rounds. We intellectually knew that it's really important as angels to stay in there till there's a strategic acquirer, as opposed to selling when there's going to be just another financial acquirer where we won't get the upside on the valuation of all the work that we've done. And now we have the data. On the left-hand side are all the rounds. So this is basically out of the 100 plus rounds that was done by our members. Left side is the annualized return of rounds that were first rounds. And that's close to 17%. And on the right side is the ones of follow-on rounds. Now, of course, some deals we don't reinvest and they die, but of the ones that do well, by and large, we reinvest, and more of the community invests because, again, of this tool that we set up, that once we're in, it can still be open for follow-on rounds in the same tool. And that's close to 30% annualized return. So continue doing the follow-on rounds. It looks like that's a good thing. Now, all of these things and all of the things that we do, we have to do it at a fraction of what normal professional angel investing services are, and that's from a shared economy. So we have programs that help people just get going. There's things where people can actively or passively build a portfolio, and then we have a whole expert and certification program so that the best investors in the community can also earn money by helping those that are more novice or who have less time. Our certification program is always based on 4 things. 1, understanding the common language and approach that we have, since especially we're in so many countries. Then is how good the portfolio, how big it is and how it's doing, how much experience they actually have doing the due diligence and more experience, and then what kind of role they have in the community. So that's where, when it's the highest, people become venture partners in the community. The one tool, maybe it's a bit hard to see, that we totally all love is, as we're building our portfolio, each line shows a round that's been invested in. I can see how the evolution is. I can change what I think the value of the shares would be now if they were to raise again. The deal leader does that every quarter, but I can override it. And especially at the end, I see how my portfolio is doing in realized terms or a net asset value, and I see where I stand versus members in the community. So that's 2 things. 1, it really gets people to want to learn more, and it also gets people to say, hey, can I start following those that are doing continuously very well, especially if somebody doesn't have time. So Theirs is, we have education for basically every part of the investment cycle. As I mentioned, we update it continuously. And that's a little bit about kind of the underlying, what we think to date are some of the success factors of members of our community. But we're a learning organization, so we continuously add to this. Now, of course, liquidity is an important thing. So here's a little bit about our experience on exits. First of all, indeed, it does take 3 to 6 years. Sometimes, again, as I said, some of us come in the later rounds, so we can shorten, but usually it is like anywhere else, 3 to 6 years. We are a community, though, that very much from the beginning are thinking that most of the exits will be from a strategic acquirer. And we really, every time we do due diligence, we look at how much do we think there is a need, how will the team work with the corporate, how open are they to being potentially exiting to a corporate. So we end up having a slightly shorter time frame to exits because we're very focused on that. Also, we're super, because the community now, we've gotten pretty experienced at really helping entrepreneurs think about it proactively. And what's good is because we're in the US and we have strong contacts in Asia, it's good we know quite in advance, often more in advance, the entrepreneur of what is the appetite from, because many of the acquirers come from those two regions right now. One thing to always remember is we don't have to exit when the whole company exits. Many times, sure, there's special rights, but in our community, we've been able to set up also that the syndicate can actually buy and sell from each other. And one general learning is that it's not over till it's over. Actually, exits are really, really hard, both technically and because often the corporates, in one of our exits, we had 80 people from the corporate who came for the due diligence. This poor entrepreneurial company had 25 employees, and it's really important. People can get super excited. It's really important they continue to watch the business because a lot of exits stop at the last minute, and the acquirers don't care about paying fines. For them, it's nothing. But if there's not a contingency plan, a beautiful company can come to a halt after all those years of hard work. So contingency is especially important. It's always important, but especially when it looks like it's almost finished, there'll be an exit because it's not finished till it's finished. So there's a bunch of types of exits. The ones, again, that we're seeing most is, there's 3. One, the reality is that they wind down or they die. It's always one of the hardest things I find is when you kind of are okay giving a bit more money to the entrepreneur, but you wonder, okay, should I maybe just let it stop? The big learning that we've had is that just because it's going to stop does not mean that there's assets that can't be salvaged and that we can at least get some of our money back. And it can be extremely time-consuming and very emotional because often the entrepreneurs start being a bit burnt out. So it usually means that at least 1 or 2 of us from the board or from others come in, and there we've in our community we say if some people really step in much more than the others, we're fine giving them a portion of what we will get or else we probably would have gotten 0. When it's a trade sale, the thing about there, we see that it really takes a lot of time internally, how to free up all this time, how, as I mentioned, that the team stays focused on some business, but also externally, because you really have to create interest. And clearly, we've done it a couple of times where there was only one buyer, and then other times when there was really actually more of a competition. And the M&A people always tell us that, but sometimes like, oh no, it's a perfect buyer, let's just stick with one. Well, the valuation is never as good, and it always takes longer. When there's real competition, the one who really wants it knows that if they say no, there's a bunch of other people wait. So when it can have more than one, that's really much better. And then the other big thing that was quite new, I mean, for experts, it's a given, but whereas we always had before only one lawyer for entrepreneurs and for the investors, here there's definitely a difference, because the founders will become employees and will probably get a really nice package, which is different than what the founders are. And so the total amount that the acquiring company is willing to pay, let's say 10 million, they'd be happy to give 4 to the people who will be employees and only 6 to the investors. So that's another reason why it's really great when the founders stay pretty significant shareholders, because then they care just as much about defending what's going to be paid to the shareholders, not just what they're going to get once they become employees. Also, it can be really complicated between deciding, do we want it all up front or do we do earn-outs, and then how much gets kept in an escrow, etc. And this is when some angels do freak out when they see, especially if it's American acquirers, the page after page of liabilities, and that each shareholder is liable and responsible. So in those cases, what we've done is sometimes some of us just rebuy at a discount of 25% or something. Those who go, oh my God, I'm too scared, and then it's fine. Usually it's normal that there's those things, but some people do panic when they see those things. And the last one is buying back from founders. I mean, there's more and more people who become entrepreneurs. There's many of them who are doing it for, in a way, a lifestyle, not because they don't want to continue to work hard, but they really don't want to go back to a corporate environment. Now, one, it's really important to know about it up front, because that changes a lot. It's much harder to get those entrepreneurs to say, yeah, I will double, triple every year my company year in, year out. They might be more happy with a 50, 30, 50% growth a year. And especially it's important to think up front, or when there's a round that comes up that looks more certain that there won't really be someone buying the company, it'll be more the founders, of how will we value it. And a lot of times those valuations are not as good as if there's a strategic investor, but in some cases that can be good, especially if we can get paid over several years. And there's ways of having kind of several payback methods to exist for this. So that's it. If any of you want, you can go on our website, and the report, I think on the homepage, you can download the report of PDF. If I was there, I would have brought you some. And this is a little bit the summary of the key success factors as an angel network. For those of you who are angel network or angel platform leaders, these are kind of what we try to do to provide best chance of success to our members.
Brigitte, thanks so much.